And some of them are mortgage licenses as well as real estate licenses. I still hold those licenses, not because I want to, practice mortgage, but it's so that I can legally discuss with clients and teach classes and so forth about mortgage finance. So we'll go over some of that. Just as a reminder, every single year for case of CE or not renewing your licenses or what have you, we have a ton of agents that we end up having to drop off of our list of active agents. So I would kindly ask that you guys make sure that you're keeping up and current with your CE, with your renewals and all those other kind of things. If you ever have questions about those kind of things, please reach out to me or reach out to Raylan. And we'll get you set up and straight as to what you might owe in terms of CE credits, what classes you need, and so forth. Because a lot of times people wait until the last minute, and then you set yourself up for being in a position where you legally might not be able to practice real estate and serve a client and help a client, and also you might not be in a position where you can earn some commission. So make sure that you're thinking advanced in that way. So today we're going to talk about Mortgage 101 for agents. We're going to go through a few slides here, and at the end I'll leave it open for discussion. It's not a too much of a thinking class. I try to make it as light as possible, but it really is to get you to understand what the different loans are, how you get different financing, what the banks are looking for in specific areas. So we're going to go over some of this stuff. So I thought I'd start off with some of the most commonly used terms that you're going to hear from a loan officer or a mortgage banker or whomever is working with your clients. Some of those terms are DTI, which is debt to income ratio. And that simply is the calculation based upon a client's credit report and what they owe and what the monies that are outgoing versus the income that they have coming in. So a lot of times when people are talking about what they qualify for, yes, credit score, some people will go, I qualify for anything. My credit scores are really high. And that may be great that they have good credit, but it also comes down to other portions of qualifications, which is down payment, or in this case, DTI, which is debt to income ratio. An ideal debt to income ratio is about 35%. But there's some loan programs, if you have a higher have a higher down payment, or the different type of loan programs would allow you to have a debt ratio of up to about 50% or even a little bit higher. The higher you get, just so you know, gets a little sketchy. And as an agent, some of the things that you should be thinking of from like a red flag or dig deeper type of thing is when you're talking to a client and that client says, yeah, I have $100,000 to put down and I have great credit and we really are motivated to make a purchase and everything sounds great, but they say something like, I'm also self-employed. That's not a red flag like you can't work with them, but that's a reason to stop and dig a little bit deeper and mainly to ensure that they really have been hopefully pre-approved at that point and speaking with the lender. And here's a reason for that is, especially in our industry in real estate, there are a lot of real estate agents that I coach and I work with that they gross a huge, their GCI is huge. Huge meaning like it could be 700, 800, 900,000, $1 million plus. But when you look at their net income after all the expenses, the marketing, all the costs that they go through, if those costs are, less than 100,000 or 50,000 or whatever it is, how does that impact you? It impacts you from the DTI, the debt to income ratio, because that's the number that the lender or the mortgage company is going to use, is what that number that they're reporting on their taxes. So just know that debt to income ratio is an important thing to understand. You don't need to know you're not the one that's running the debt to income ratio, but you have to understand why it's important. And there are certain keywords that should trigger you to ask more questions. LTV is loan to value. And that simply means what the loan amount is relative to what the purchasing price is, or if it were a refinance, where we're not talking about refinances, is what the equity position is. So for instance, if you're at an 80% loan to value on a purchase, that means, simply put, that the buyer is putting down 20%. Combined loan to value is an indication that there's a second lien on the property. So for instance, you could have an 80% loan to value and a 90% combined loan to value, which that tells me is they're putting 10% down. They have an 80% first mortgage and a 10% either a HELOC or a second mortgage. When a few of the properties that I've personally have purchased is spread out like that for a reason. So you can put down 10% and 90% be on one loan. But if you do that, moving on to the next one down on that list, which is PMI, is private mortgage insurance, is PMI kicks in when you finance over 80% on one loan. And so what PMI is, it's another cost and that another added layer of fee that the buyer will have to pay that doesn't benefit them per se. It doesn't. It's an insurance that covers the lender who's doing the financing. And the cost of that insurance per month will fluctuate depending on the risk. And the risk is going to be dictated by their FICO score, by how much over that 80% it goes. So for instance, let's say that someone's just kind of out of money and all that they're putting in every last resource and dollar that they have, and they're at 81% or 82%. You're going to have PMI, but the PMI is not going to be as high as if it were 85% or 87%. The higher that goes up, the more or the PMI that the buyer will have to pay. So private and mortgage insurance is sometimes it's a necessity, but there's ways to try to avoid it. And one of the ways that I just mentioned before is you can split the loan up into two. So if they only have 10% down, could they get just all one loan in 90%? Yes, you could. But you also might want to consider doing 80% on the first loan, a 10% second, and then the 10% down. So at the end of the day, it's the same down payment that the buyer will have, but you're splitting up the loan in such a way to get a better interest rate on the first mortgage and also avoiding PMI. Are there risks involved in that? Sure. If you have a second mortgage that's a HELOC or an equity line of credit, that is often tied to the prime rate. So as you guys know, prime rate it can fluctuate. If they raise the prime rate by a quarter point, then that loan goes up by a quarter point. That's just the HELOC portion, that 10% portion of it. If the first mortgage is a 30-year fix, then that's not going to be impacted at all. PMI and MIP are kind of interchangeable. PMI is for conventional loans. MIP is something that is typically on the front end that's charged for like FHA, other kind of government loans, USDA, and so forth. An ARM is not something that's used often anymore. An ARM stands for adjustable rate mortgage. If anyone was around our industry or even kind of heard about the mortgage meltdown in 2009, a lot of that was ARMs, adjustable rate mortgages. So people were getting very risky type of loans or type of financing, which led to, people who probably shouldn't have qualified to purchase a home, buying a home, and then they couldn't sustain when the market fluctuated. So what an ARM is, and I think that these kinds of loans will circle back and make its way back around. So it's always good for you guys to know what it is an adjustable rate mortgage could be fixed for anywhere from 1 year to 3 years to 5 years, 7 years, and it becomes adjustable thereafter. So if someone says, that, like, I'll give you an example. Let's say they're military, they're here for 3 years, and they say, I'll get a 3-year term because I'm not going to be here longer than that. Is that a good idea? Well, the one good thing is they're probably going to be paying a lot lower of an interest rate on a loan that's fixed for 3 years than a loan that's fixed for 30 years. The downside becomes there's not a good exit strategy should their plans change. And their plans changing could be, we're staying longer than 3 years. Now we're going to be staying for 6 or for 7. Well, if that's the case, now they're staying into an adjustable period, which means that they're forced then to possibly refinance or sell the property. Or what if they intend on selling it in 3 years because it's fixed for 3 years, but the market changed? And if the market changed and they can't get what they thought they could get for it, and they might be upside down in rare circumstances, then that's a problem because they're upside down, which means they have negative equity when the property is not going to be able to have a fixed rate. So they'll be in an adjustable time frame in a negative equity situation, which is really bad. Another term that's used often in in mortgages and refinances and finances in general is distressed property. And a distressed property is a property for sale whereby the owner is in some sort of economic duress. So distressed property could be a probate sale, a bankruptcy sale, a divorce sale, short sale, foreclosure. That's all the pile, if you will, of distressed properties. And is that important to understand? Well, lenders will typically finance it. They don't really care so much if it's a distressed property, but it all comes down to condition. So if you think about it, if the property is foreclosed and been vacant for a couple of years, has it been maintained to the standards of someone who owner occupies that property? Probably not. So there's a condition issue that you have to keep in mind. And when they do an appraisal, and the appraiser goes out there, the appraiser is kind of the eyes and ears and boots on the ground for the lender. So if the condition of the property is subpar, the property may not be a term called lendable. So it may not be a lendable property. What's the most commonly used mortgages? So there are tons of mortgages out there. Here's the most commonly used ones, which is conventional. I'm sure you guys have heard that term before. And in conventional, there's conforming, non-conforming, jumbo, conforming jumbo. There's adjustable rates, fixed rates, interest only. So what does conventional mean? You guys have all heard of the term, I'm sure, Fannie Mae, Freddie Mac. Those are quasi-government insurance companies that insure loans. And here's the whole reason for that is if anyone is old enough to remember, or maybe they've read about it, or they have parents or grandparents that have, lived through that time, is back in the day, I say back in the day, 40, 50 years ago, when a homeowner wanted to get a loan to purchase, they would go into their savings and loan, and they would kind of plead their case. Like, this is my job situation, and here's my pay stubs. And it's that individual that's sitting across the desk that would make their determination whether this person was credit worthy, and then loan them X amount of dollars to make a purchase for their home. And in doing so, they were dealing directly with kind of the loan officer / underwriter all in one shot. Well, here's the downside. The downside is if there's any fluctuation in the economy, or that savings and loan went under or closed, the loans or the notes that company or bank had were not saleable on any market because they were underwritten with no guidelines or no standards in mind at all. So, Oahu Savings and Loan couldn't necessarily sell it to Maui Savings and Loan because the standards were completely different. So the notes, the mortgages became worthless. So Freddie Mac and Fannie Mae, those quasi-government insurance companies, created standards, which is why it's called conventional or conforming loans. It's conforming to kind of a general set of guidelines. And the benefit of that is now mortgages are packaged together and sold as a commodity on the open market. And which is also why if anyone has a home that they've refinanced or that they purchased, you ever go through your loan officer at, ABC Mortgage Company, and then you close, and then 2 months later you get a letter that says, oh, by the way, we sold your loan and now it's Wells Fargo. And then 6 months later you get a letter from Wells Fargo saying, hey, by the way, we sold your loan and now you're with, Jeannie Mae or whatever the company is that might be servicing it. So the reason why that happens, for better or worse, it's kind of irritating because you got to switch websites and switch who you're paying, and your auto pay has to start all over again and those kind of things. So that's the inconvenience part. The benefit part of that is it's driven interest rates down because it becomes a commodity that everyone is sticking and playing by basically the same rules. That's why it's conforming. So just know that that's kind of what that term means. Conventional loans, there's all kinds of different parameters, and we'll go through that in terms of down payment and so forth. So aside from conventional, there's also VA, and VA is for veterans or spouses of veterans that qualify specifically for that if the veteran has passed or in other circumstances like that. VA loans are also assumable. Assumable simply means that it's not relevant to the market that we're currently in, but you will oftentimes see it in a market that switches to like a buyer's market, not typically a seller's market. So What is an assumable loan mean? Well, let's say that you have a VA buyer that's been in the property for 5 years and he has a really low interest rate. Let's call it 2%. And right now the interest rates are not 2%, they're 3.75. So what an assumable loan simply means is that a VA buyer can assume the existing balance, term, payment, and the loan that's remaining and existing on that property without having to get a brand new loan that starts all over again. And the great thing about that, if it made sense to do so, is that new buyer is walking into that, in this example, that 2% loan versus a 3.375 loan of whatever today's rate is. So is that a good thing? It could be. It could be a great thing, and it could be a great selling point for a VA qualified individual to assume a loan. They still have to qualify in other regards, but they can assume that loan. Here's the thing though, if they're assuming that loan, that buyer still has to come up with a cash difference of whatever it is that you want to sell it for. So assuming that you've been in that property for 5 years, especially what's been happening recently in the last couple of years where equity is increasing substantially and it's super hard to find a home, and people's property values are going up. It's bananas out there. So if that's the case, and the equity in a 5-year period of time has increased by, let's call it 250,000. If that VA buyer is assuming that loan, who's going to make up the $250,000? That can't be financed because you're not financing anything. You're just assuming an existing loan. So it does work, but it works in very rare circumstances because that's that portion, that difference that, like, in other words, yes, there's a savings to be had to have a 2% interest rate versus a 3.75 interest rate. But if you got to come up with the difference of 250,000, is that convenient for a VA buyer? Probably not. They'd probably rather have today's interest rate and finance the whole thing with no money down. So there's different reasons as to why that might show up. It typically will show up when the market shifts. When the market shifts, you're going to get a lot of creative financing. You'll get a lot of VAs assuming loans and so forth. So VA loans typically are 15-year fixed or 30-year fixed, by far and away 30-year fixed. And then there's FHA and USDA. FHA is and USDA are both government loans, just like the VA. So we kind of in lending we call that govies or government loans because there's some sort of government entity or administrative service that underwrites and processes those loans. So the nuance between all three of them is VA is for veterans only. They have a 0% down payment, which is amazing. For veterans, you absolutely can put money down to lower that payment even further, but that's the benefit that veterans have and active duty who qualify for it. And the interest rates on VA loans, generally speaking, are very, very competitive, which is good. FHA is at least at minimum 3.5% down. So that's typical for first-time home buyers. It's a great loan program to have. Kind of loose qualifications, meaning that you don't have to have unbelievably good credit to qualify for an FHA loan, which is great for people starting out because you're kind of trying to get your foot into the door in home ownership. How do you begin doing that if you don't have a home to sell, to have equity position or what have you? FHA loans are typically a good starter loan or first-time home buyer loans. You guys ever hear of like the marketing piece, like, hey, we have a first-time home buyer, or we have a first-time home buyer program or loan? They're really kind of repackaging that. That's really an FHA loan. That's basically what that is. It's not like a new loan that some credit union is inventing. For the most part, it's an FHA loan. There's some nuance on FHA loans. FHA does have like a rehab loan, and last I checked, I think you can borrow up to 100,000 or 25% above the purchase price as an extra amount of money to rehab or rehabilitate a home. So the benefit in doing that is if there's a home that is not lendable, as the example I gave before, on a conventional loan, because maybe it's distressed, maybe it's a foreclosure that's been vacant for so long and it needs some work, there is a FHA rehab loan that's available to purchase, but it's not available for investors. So if you have a client that's flipping, that's not the right program for it. It's for someone who intends on occupying the property and needs extra funds to rehab the property. I've been in the industry for about 22 years and I've only done 2 of them successfully. They're not easy to do. So it's available. It doesn't make it easy to accomplish though. So just letting you know that. And then USDA, yes, it's the beef people. Their loan is a rural loan. So it's meant for not the densely populated areas, but the areas outside of that. So specifically on Oahu, it would be like North Shore, Waianae, Makaha areas. It wouldn't be in town or the densely populated areas. So they also have 15-year and 30-year fixed. A USDA loan is 100% financing, just like the VA is. The nuance with the USDA loan, though, is it's a sweet spot in terms of their qualification. So yes, you have to qualify to make that payment, but you can't make too much. So it's a sweet spot. So with the VA, FHA, and conventional, you could make $3 million a year and it wouldn't disqualify you. Whereas for USDA, it will. You can't make too much, and there's a sweet spot that it has to fall into. So, and speaking about these same types of buckets or categories, conventional has as low as a 3% down payment. So when you guys are working with the buyer and the buyer says they don't have, much cash available or what have you, that in and of itself shouldn't disqualify them. It's all relative to what they're purchasing and their FICO scores and so forth. But know that conventional has as low as a 3% down payment. Of course, to offset that because of the high risk is they have to have a high FICO score, high credit score too. It's going to require PMI, private mortgage insurance. That's what I mentioned before. So that applies to anything over 80%. And in many cases, like I'd mentioned, you can split the loan up into two. So you can do an 80% first mortgage and a 10% second, or a 15% second, or what have you. There's a lot of ways you can split that up. With VA, 0% down payment, there is something called a funding fee, a VA funding fee. That ranges from 2.3% to 3.6%. And that range is based upon if it's a first-time use, if the veteran is considered fully or partially disabled. There's a lot of different variants to why those fees are there, but that fee is not to the lender. That fee goes back to the VA, and it's basically to keep that program going. FHA and USDA, as I'd mentioned before, 100% down payment for USDA, but it's area specific. You have to be in that sweet spot again in order to qualify. And FHA is 3.5% down payment. There is a funding fee there too. It's 1.75%. And FHA has a monthly MIP. So MIP is the mortgage insurance premium. It is basically the same thing, but the government version of PMI. So you don't have to have MIP on an FHA loan if you put down a certain amount of down payment. But why would you put that down payment? If you did, you would just go to conventional. So some of the things kind of don't make a whole lot of sense, but you want to make sure that you're talking to a good loan officer to help you navigate through that. Okay, talking about where the most commonly used mortgages come from. So this is on Oahu specifically in 2020. I ran some of the numbers. So conventional, by far and away, as you probably imagine, took first place with 5,200 conventional loans. Now, by the way, it doesn't mean that someone's not a veteran and use a conventional loan. They could have already. So with a VA loan, you can't keep using it over and over and over again while loans are currently in place. That's called entitlement, the VA entitlement. So you have to have that entitlement freed up. So oftentimes what I've seen is they've either cashed out, like a veteran owns a property, maybe took some money out, some equity out of that property, and then used that equity as a down payment to get a conventional loan to buy something else. So they're still fully qualified for VA, but their VA loan is currently being occupied and used. If they were to refinance that VA loan into a conventional loan, they can then reuse that VA loan all over again immediately. Or if they sold it the very next day, they can use the VA loan again too. So there's some limitations in that. VA comes in second with almost 2,400 closed. FHA 210. Again, FHA is a little bit trickier. Agreement of sale, and I'll talk about that in a second. There's construction loans. Construction loans are kind of a two-part loan. So there's a loan in place typically to buy a property or buy vacant land. And there's a certain amount of money that is already financed to do so. And there's phased release of money in order to renovate or build or whatever that is. And phased release simply means that you could have like a 2-year loan. Let's say it's a total purchase of $1 million, but the land that you're buying is 500. You immediately can get a loan to finance the 500. And in phases over the course of 2 years, in this example, the lender is going to give you 250,000 and another 250,000 and another 250,000 and so forth until you phase out all the renovation or build. And then they convert that loan in 2 years to something else, like a 30-year fixed. So that is still a viable option. As you can tell, 10 of them were closed in 2020. It is not easy to get. There's a lot of nuance to that. You typically have to be working with a contractor who is making, obviously they have to be licensed and bonded, but they got to make sure that all permits are being handled and facilitated the right way. But that is a viable option if you know what you're doing. Then commercial loans. Commercial loans aren't necessarily and only industrial or business buildings or things like that. Commercial is also categorized as, you guys ever see like units, apartments or what have you, with like, more than 4. Anything that's more than 4 units would be considered commercial. So if you're buying a residential 5, like a small 5-unit apartment and you finance it, that would be a commercial loan. So there's 141 of those that closed in 2020. And they're all nuanced, right? So commercial, the beauty of commercial is the lender is qualifying you as a buyer or whomever the buyer is far less than they're qualifying the actual property in terms of income. So the beauty of that is you could be maxed out on your income, but if you found a property that makes sense and you had enough down payment and you qualified for at least that the down payment portion of that loan, the rest of it is based upon the income that property produces, not necessarily your personal income. Balloon loans, there's 20 of them that closed in 2020. A balloon loan is a loan it's basically a short-term loan to some extent. So you could have a balloon loan that's, for instance, fixed for 2 years or 3 years, and it's not adjustable thereafter as with the adjustable rate mortgages, which is the last one and the one I spoke to before. A balloon loan, the entire amount is due. So rather than it being adjustable to a certain index after its fixed period, a balloon loan after its fixed period, the entire amount becomes due. So if you're financing $1 million and it's fixed for 2 years, and the balance of that after 24 months, after 2 years is $950,000, then what's due immediately on the first payment is $950,000. So it's not, there's no such thing. Some people might be thinking that sounds like a bad loan. There's no such thing as a bad loan at all, believe it or not. There's no bad loans. It's just, it could be the wrong loan for the wrong buyer and the wrong scenario. So this is not, this class or mastermind is not intended to make you guys loan officers, but rather to be able to think outside the box and kind of understand the nuances between the different type of financing that a buyer can get. And it makes you more informed when you're having that discussion, that buyer consultation, to decide what route you guys are going to go. It also is very helpful too. I've saved so many transactions being on the listing side and seeing how people are structuring and writing offers in. And I'm looking at the contract going, there's no way that this is a conventional loan with, X amount of down payment or no down payment or whatever it is. So it does help you just become a little bit more aware for the benefit of your clients. And then lastly, as I told you, I'll circle back to, is something called an agreement of sale. Only 4 of them were closed in 2020. Some of these loans, specifically that one especially, is cyclical depending on the market of the moment, the market that we're in at the time. Agreement of sale is a very common type of financing that you'll see in a buyer's market. So as you guys know, we've been in a seller's market for the last 10 plus years, and a heavy seller's market certainly in the last 2 or 3. Agreement of sale is basically a form of seller financing. So I'm sure you guys have heard that term before, seller's financing, even though those agents that are relatively new. So why would a seller even entertain financing in a market like we're in right now, where anything can sell for the most part relatively quickly, and even for the most part above asking price, and there's competitive offers and so forth? There's no reason for a seller to ever consider an agreement of sale normally under normal circumstances, or seller financing. But in a buyer's market, everything changes. In a buyer's market, it's a completely different thing than a seller's market. And in the nutshell of an agreement of sale is title doesn't transfer. So if I'm selling my home, I'm gonna use Robert as an example. I know Robert's on the call. So Robert is the buyer and he wants to buy one of my properties and it switches to a buyer's market. What an agreement of sale is basically is I am agreeing to do business with Robert and finance. So I'll say, Robert, I'm going to need 20% down and then you're going to make monthly payments to me of X, whatever we agree to. And there's a form for that. And your broker, I highly recommend that you speak to your broker about it because there's a lot of nuance behind it. The benefit to me in an agreement of sale as a seller is title doesn't transfer. So on day one, there's nothing that transfers to in Robert's name. The title is still in my name. And if I agree, depending on the terms of the agreement of sale, it could be a 12-month period or it could be a 12-year period. So depending on what we've agreed to, title doesn't transfer until the last payment is made. So that could, again, that's a negotiable item. That's a benefit to the seller. And why is that a benefit? Well, there's no foreclosure that needs to take place. So if Robert decides, and Robert would never do this, but if Robert decided not to make payments or continue making payments 3 years into our agreement, there's a certain scale. There's a certain, I forgot the timeframes, but there's a certain period of months that have to go by that he's basically defaulted and I can just take the property back and there's no foreclosure action because title never transferred to begin with. Whereas if title did transfer in as an example, in a conventional loan or some other kind of financing where title did transfer over to the other side, then you are a lender. Then you have to take action as a lender, and there's all kinds of laws and restrictions and so forth on how you have to proceed with that. And that could take a lot more money and a lot more time in order to facilitate. For those of you who have visited the mainland or gone on road trips in the mainland or are from the mainland, this doesn't happen very often here. In fact, I can't even think of an instance that it has. But have you guys ever seen those big billboards? It's usually like a handmade billboard or sign of some sort, spray painted or kind of do it yourself style, that it says 20,000 acres for sale, seller will finance. Have you guys ever seen that? In the mainland, they're using an agreement of sale, and in the mainland, that's kind of, for the most part, a tactic. And what I mean by that is they hope that you finance with them in an agreement of sale, and they're going to say, hey, we're going to sell you this 20,000 acres for $50,000. Can you imagine 50,000? That's all. That's it, just 50,000, and I'm going to give you 20,000 acres. But what I'm going to need from you right now is a down payment of $5,000 and then $600 a month or whatever it is until it's paid in full. And they do that. They collect their money, their down payment. The buyer typically will make anywhere from 1 to 12 payments. And then they're like, you know what? This is ridiculous. I don't even know why I wanted that piece of land in the middle of nowhere to begin with. I'm just going to stop making payments. And the seller wins because the seller doesn't have to give you back anything. They're not buying anything back from you. Title never transferred. Then that sign goes right back out front again. 20,000 acres for $50,000. And they're waiting for the next guy to give them that $5,000 down payment and make enough payments until they decide not to, and they're not motivated anymore and so forth. So that's kind of a thing that happens in the mainland quite often. I think someone had raised their hand. Is that right? Oh, Chiro, yes. You can take yourself off mute.
Great. Sorry, by accident.
Oh, did you have a question?
No.
Oh, okay. No problem. Okay, hold on. Hard money loans, Dean wanted me to ask. And is that similar to subject to? Dean, come off of mute real quick and explain what you mean by subject to, because subject to is something that is typically referred to on the appraisal side, but are you asking something else, or is that what you're referring to?
Can you hear me? Sorry.
Yeah, we can hear you fine.
Yeah, sorry, the hard money was a little bit of a side comment, but the subject to question was more related to the seller financing. And I've heard of investors using strategies called subject to, and I thought that was kind of similar to like a seller financing, to your point, where the whole thing is you want them to default so that you get the whole property back. But I'm not 100% sure. I just heard that term thrown out in these potential training modules that I hear,
Thank you for sharing. So yes, I know what you're referring to. It's not. Well, Scope, let me just say this. What he's referring to too is there's a lot of like seminars out there that teach people how to buy and flip and that type of model. And that model, a lot of it is geared towards not working with a real estate agent. Just I'm trying to separate the two out just so you can kind of, is there nuance in between and gray area in between? Sure. But as a general rule of thumb, because I've attended some of them too, because they're interesting to understand what they're sharing with the public. And a lot of them don't want you to work with real estate agents, and they don't encourage you. If you're attending the seminar, a seminar attendee, they wouldn't encourage that attendee to become licensed real estate agents as well. And why is that? Because we're held to a completely different and higher standard of being a licensee. We can be sued and fined, and our licenses be revoked, and all these other kind of things. Well, what they don't know on that other side too is so can they. They don't have a license, but they can absolutely be sued, and they can also they oftentimes will commit legal malpractice and real estate malpractice too. So they're still on a hook for some things, but just know that there's a lot of new terms that come out of that market, and that market is oftentimes very trendy because you see it on TikTok, you see it on YouTube, and it's kind of like the phrase of the day that's being spun around in some of the groups. And subject to is more of a legal phrasing that is not talking about a specific loan, but it's how they're negotiating certain things or components within the contract, so that this is subject to X. And if X doesn't happen, then we either get a per diem or we get the property back, or it's that kind of thing that's what that's referring to. With regards to hard money, and thank you for bringing that up. I don't know if I have a slide on that. I think I do, but hard money is the same thing as private money or portfolio. And basically it doesn't fit into any of the categories that we've discussed thus far, which is traditional financing. And so I used to be, as an example, I used to invest in a hard money group. So I was one of the investors in hard money, and we write our own rules in terms of what we're willing to offer a loan on. At that time, it was in Southern California. So we were specific to like Newport Beach area or anything that's within Orange County. And the reason why is we wanted to be able to drive and see the property, see the condition of the property. If our money in dollars are going to be tied up there, we wanted to see, we wanted to have easy access to the property. So you can do that, and you can create your own loan to value restrictions and so forth. A lot of the hard money type of loans, you got to be careful of it on both sides. They're a great option for potential investors if that investor is savvy and have used them often. But hard money lenders sometimes run out of money or go out of business. So it's kind of if that's your demographic as a real estate agent and dealing with investors, I'm not saying that that's a bad thing, but there's a lot of risk involved, and it takes a lot of grit and tenacity, and it's not for the faint of heart. It is certainly not something a new agent should be getting involved with. There's too many ways that you could get sued or drop the ball or lose your license in dealing in that demographic. You could absolutely work your way up and have a viable business and a thriving business in servicing investors, but it's a much trickier thing to go down. So, and I can help you with those kind of things later too. This is often something that's discussed too. What's the difference between pre-qualification versus pre-approval? Because the two aren't necessarily interchangeable. So here's the difference. A pre-qual or pre-qualification is basically a credit check. And I say most cases because you can call a company like Rocket Mortgage and just say, hey, my credit is really good. I have an 800 credit score. And here's my income. I make, $500,000 a year. And here's my employment. I work for ABC, whatever company. And they're going to go, yep, looks like you qualify and you can purchase up to X. Well, that is a pre-qualification. It's very loose in that scenario. It's very loose to the extent that how do they even know what debts you have? So that whole debt to income ratio conversation. I mean, what if you have 10 properties financed and they don't even know that because they don't even have your credit. They don't even see those other things pop up. There are some local lenders that will do a pre-qualification, but they're going to actually say, we're going to run your credit and so forth, which is much better. Then there's a pre-approval, which by far and away is way better if you can get this, which is, yes, they absolutely will run your credit and do a credit check. Not to mention they're going to get your income documentation. So Income documentation, as I mentioned before, looks a little differently depending on the scenario of the buyer. So if it's a first-time home buyer who's in the military, you can get away. You want to document the income, but you can kind of get away with, you don't even need to have that if their scenario is pretty easy. Scenario being pretty easy, meaning they've never used their VA loan. They don't own any other properties. They're a first-time home buyer, and here's their rank. Because their rank is published, a lender can figure out what the COLA is, the cost of living. They can figure out what their BAH is, and they can figure out their income based on their rank. So they can't underwrite based on that, but you can be rest assured that that credit check and pre-approval process can take place pretty much in the same day, which is great. However, if you, fellow real estate agents, are the buyers, that's a different thing. We write everything off. We write as much things off as we possibly can, and we're considered self-employed. We have a 1099 at the end of the year. So in that circumstance, you could, like I mentioned before, your GCI could be $1 million a year, but your adjusted gross income and your net income could be, and probably should be, substantially less than that. And then it's, how long have you been doing this for? How long have you been consistently doing this self-employment business for? Most lenders want to see at least 2 years that you've been doing this with a consistent trend of equal income or rising income. So if your income in your first year in real estate was 100,000 and in your second year is 50,000, they don't average the two out. They give you 50,000 because your income is going down. If, however, your first year in real estate is 100,000 and your second year is 300,000, then they're going to average it out and give you 200,000. I know it's not fair, but that's what they do. They underwrite it based upon risk factors and worst case scenarios and so forth. And they'll verify your employment, or in this case, in this example, who your brokerage is and how long you've been there and so forth. The tax returns become very necessary, even if someone is salaried or in the military, if they have multiple properties. And the reason for that is they want to see what they're writing off on the different properties, or if they have other businesses they're tied to and so forth. So that's where the tax returns come in. So ideally speaking, this is important to know too, because if you're on the list side, so you're listing a property in today's market and we're getting a ton of offers that come in, you got 7 offers, and you have one that appears to be the strongest offer, the question that you should ask and call the lender for is to find out, has this buyer been pre-qualified or pre-approved? And then now you know, and now you can ask more detailed questions about it. So, okay, great, it's been pre-approved. Have you received all their income documentation? You've seen their tax returns already? No issues, no questions about that? Those are things that I would ask, because what seems to be the strongest offer might not be the strongest offer when you start digging a little bit deeper. And I'm sure, I hate to say, but I'm sure that that listing agents that are on here have dealt with agents that have written offers that didn't come to fruition. And halfway through, things are kind of shaky and falling apart. And it had nothing to do with the seller or the property or the inspection or anything like that. It has everything to do with how they structured the financing, and the buyer is really not qualified to begin with. So this information is helpful both on the buy side and the list side. On the buy side, you want to be in partnership with, I would say, anywhere from 2 to even 3 lenders that you use on a kind of rotational basis, of ones that you trust that will work hard and really are good at problem solving. And in doing so, when a buyer comes to you and they're not yet approved or pre-qualified, then you can go, do you know the difference between pre-qual and pre-approval? Let me send you to my lender who will do a pre-approval to ensure that we have a strong approval letter when we submit offers. Where can you get a home loan from? I used to kind of draw this out. I used to make it in circles. Anyone who's seen me do a buyer consultation has seen me do this. I explain this for a reason, because people get confused as to what is available out there, and they're all the same. I'm just going to go to my American Savings or my credit union to get a loan. And I don't doubt why that is, in terms of the sake of ease and convenience and so forth. But one of the things that people have to remember is, when you're in contract, all parties to the contract, so the buyer and the seller and the agents and title and escrow, and in this case the lender, have to be performing within the same timelines that's illustrated on the contract. So the issue that comes about when you're dealing with a Bank of Hawaii, or American Home Loans, or American Savings rather, or some credit union that's here, or USAA, or Chase Bank, or Bank of America that's a mainland bank. The problem with that, they don't underwrite to our contract. They underwrite to the timeline that their underwriters and loan processors are running at. So here, what I said is that if your timeline to try to be competitive, this is a seller's market, there's multiple offers received, you wrote that offer to close within 30 days, and that lender that the buyer has chosen to work with, USAA or Navy Fed is a huge violator of this. If their underwriting is 60 days or 90 days, what does that mean for you? You're already going to breach. There's no way that you can close in that time frame because you're now subject to their own timeline. So there's a difference, right? So the first circle that I have here is banks. Banks, credit union, any brick and mortar that you kind of walk into is one source that you can get a home loan from. And I'm not saying that they shouldn't get their mortgage from there, but it's far easier to refinance with a company, because when you refinance, you're not under contract. You're just refinancing to whatever the current rates are. But if you're in contract, if you think about it, when you guys walk into a bank and you deposit your check or you're getting money out or whatever it is, and on the countertop, there's that little plastic sign and it says, today's interest rates, and it says 2.75%. You're like, wow, 2.75, that's pretty good, because right now it's 3.5 as an example. Then you look at the fine print and it says 2% origination. So first and foremost, know that you're going to a place to get a loan that their specialty is not loans. How does a bank make money? Is your deposits. That's the main source of their income, is to get as many deposits, which is your checkings, your savings. When you deposit your paycheck, there is not someone in a little visor with a little, tight thing up their sleeve sitting in the back safe counting money. That money doesn't exist, right? So what they do is they deposit your money and they're investing it into other things such as loans and other investments and what have you. So that's the main source of their money, is usually deposits and that sort of thing. It is not home loans. So from the home loan perspective, they're not, they don't have the same sense of urgency as another type of company would. So could they offer some sort of special? Sure, that happens from time to time. Most banks, though, are not what it seems in terms of the interest rates. As I mentioned before, and I have another slide on it, is the cost to do business with a lender or a bank or a brick and mortar type of a credit union is usually much, much higher than dealing with a direct lender. And they take longer as well. So that's one source, is a brick and mortar bank or credit union. Another one would be a mortgage broker. So what a mortgage broker is a broker in this sense doesn't have any money on their own. What they're doing is they're connecting two people to money. So let's say hypothetically that you're working with a buyer that has a weird type of credit scenario. Let's say that they had a foreclosure that happened 2 years ago, but they worked with an attorney to get it off, and their credit score should be a little bit higher than it probably is. It's one of these kind of things where, like, this is a great guy. I think there's something there, but it's definitely not going to fit into traditional brick and mortar type of bank. And I don't think it's going to work with some of the lenders that I deal with either. This is where a mortgage broker shines, because a mortgage broker has anywhere from 20 to 50 relationships with traditional banks, but also the nuanced niche type of lenders. Some of them might be in Kansas City, or some of them, whatever the thing is, that, oh yeah, we deal with that. We deal with people that have credit challenges or self-employed and can't verify all credit or that kind of thing. And so what a mortgage broker will do is he'll reach out to all their sources and figure out if they have some type of financing option for that buyer. What does it cost that buyer? It costs them, they're going to be paying usually an origination fee or higher loan or closing costs. But it's worth it, right? Because in this scenario, in this example that we're talking about a buyer that otherwise would not qualify for anything at all. So the fact that they might be able to qualify for this rather than nothing at all, it absolutely is worth it. But you have to know your sources of loans so that you don't inadvertently put someone in the wrong, align them with the wrong vendor or relationship. Meaning, if someone is unbelievably well qualified, why would you stick them in a mortgage broker that might cost them more? And then lastly, is a direct lender. And direct lender by far and away is probably the best source for a home loan or to get someone qualified. That's all that they do. And the difference, the main difference between a direct lender and a mortgage broker is, as I mentioned before, a mortgage broker has no money. They're just connecting you to the money. They're brokering the deal. Whereas a direct lender, they are the bank. They're essentially, they have a giant line of credit and they're lending their own money to close this $1 million transaction or escrow. And then what they do immediately thereafter is they go and sell it to the bank. It's kind of a weird incestuous kind of relationship, but the direct lender is going to do all the work. They're going to underwrite it and process it and fund that loan. And then within 30 days to 90 days, they're going to go back to, Bank of Hawaii and say, hey, we have this loan for you. Would you like to buy it? And then suddenly the buyer's making the payment to Bank of Hawaii instead. But for that, the cost is driven down. The timeline is shortened because you're dealing with everyone in-house. Closing costs are super competitive because a direct lender does not make money on car loans or deposits or savings or checkings. All they do is mortgages. That's the only thing they do. So in short, I'm not saying not to use a bank or a mortgage broker and only use a direct lender. You can use whatever you want, but no, there's an appropriate relationship for the scenario of the buyer that you're working with. And it really is important to understand that. So going into closing costs, there are lender fees. Lender fees are origination. There's a difference between origination and a discount point. And my next slide will help differentiate that a little bit. But what I will say this is origination typically is on a broker side, not on a lender side. It also can happen, I should say too, it also happens on the bank side. So bank and broker origination, lenders typically don't. And what an origination fee is just basically the cost of doing business with that company. So it's like, hey, we're Bank of Hawaii and we're going to charge you 2% on every loan that you do. And just because it's convenient, it's easy, it'll be tied to your checking account. You can pull it up on your app and that's why. So you're kind of just paying for the building. You're paying for their mortgage and their, no pun intended, but you're paying for their operating costs and marketing costs. I personally feel that's completely unnecessary. I've never paid origination fees in my life. There's no reason to ever do that, but you also have to know what that is so you can look out for it to help a client avoid it or explain it to a client. What is a discount or buy down points? That's the same thing. The discount and buy down is used interchangeably. What that is entirely different than origination. So it can show up like a percentage. So let's say origination point 1 point. Discount point could also say 1 percentage point too, and it's a percentage point of the loan amount, not the purchase price. But what a discount or buy down point is if there's an interest rate that, let's say today's rates is 3.5%, and your buyer wants an interest rate of 3%, the only way he can get it, and I have a subsequent slide to better explain this, is he has to pay the difference of whatever that is, because he's buying an interest rate that's not available on the open market. And so remember I mentioned before the whole term conforming rates and conforming loans and so forth is we're all operating, generally speaking, off of the same interest rates. I mean, it's typical. It's not typical, rather, that one bank will have 7% and the other one will have 3%. I mean, generally speaking, we're all in the 3s. They might fluctuate by 1/8 to 1/4 point here and there and fluctuate in fees and service, but it's not fluctuating by a full point or more. It's not happening because we're all operating off of the same economic momentum. That being said, the discount and buy down points are fees that a lender will charge to get an interest rate that's lower than the market currently offers. And so the first question is, does it make sense to do that? It depends entirely on their circumstance. So if it's a military person that's coming in here for 3 years and their lender's like, hey, you should get a discount point. It's going to cost you an extra point, which equates to $5,000. But hey, you're going to save $150 a month. Some people get caught up in the $150 a month savings. They're like, ooh, that sounds like a great idea. But you got to do the math. How long, does it take $150 into $5,000? Does that exceed 36 months? Because if it takes 5 years, for instance, then you're overpaying for that. You're overspending for the savings that you would have. But if it takes you 2 years to pay off that 5,000 and they're here for 3 years, that's a great buy. That's a great investment to have as a buy down or discount. Or if for instance, you say you're talking to a client, they're like, I bought homes in the past. This is my retirement home, and rates are so, and by the way, rates are historically low. So anyone complaining about rising interest rates has no idea about where rates have come from. But if someone says, this is my last home, my retirement home, I want to buy this property, I'm going to live in it forever. You can bury me in the backyard. I'm not refinancing. I'm not selling at all. And someone like that, they absolutely might want to buy down or a discount point. Because, even if it took them 4 or 5 years to pay off the cost to buy it down, everything at that point is complete savings. And when you do the math on mortgages and interest paid, the savings that can be had by buying down your interest rate is not only sometimes in the tens of thousands, but sometimes it approaches into the hundreds of thousands. So the savings is absolutely substantial. It doesn't mean that you should just immediately jump towards it. You have to do the math. The math is pretty simple though. The math is by the way, the term for whatever the going rate is called a par rate, PAR. So the comparison to do that math is what's the par rate today? Again, in this example, 3.5%. How much would it cost to get down to 3? So half a point reduction. And whatever that dollar amount is, do the 2 payments. So at 3.5%, the payment is, I'm making numbers up at this point, but at 3.5%, the payment is $3,500. Whereas at 3%, the payment is, $3,200. And you take the 300 into the cost, which is 5,000 in this example. And how many months does it take to recoup that initial investment? That's the math. And for whatever reason, loan officers don't even do that math. They're just always pitching, hey, origination or buy down or whatever it is. And that's the math to figure out, does it make sense to do that or not? Going down that list further, underwriting fees, that's typical processing fees. Underwriting fees can be anywhere from $500 to $1,200. Processing fees about the same. Appraisal fees. So an appraisal is to the benefit of the lender, not to the buyer. We absolutely, there is a benefit to the buyer, which is to ensure that the buyer doesn't overpay. But to whose safety mechanism does that fall under? It's definitely to the lender, right? Not the buyer. Lender fees, I have that in quotes because some lenders kind of throw in all kinds of weird fees on top of that, or what we call junk fees. There's prepaid interest. Prepaid interest is, so if you close a loan, what's today's date? The 8th. We close today. My next payment is not due April 1st. So on any mortgage, if you closed right now today, your payment is not due on, in this case, the 1st of April. It'll be due on May 1st. Right? So, but there's still interest to be had. So that's the prepaid interest. From the 9th or the 8th to the end of the month, that's going to be part of what it looks like closing costs, but it's not closing costs. It's the interest that they need to accumulate. And then your payment that's on, I'm going to confuse everyone right now, but if you're homeowners, you probably understand this. If you're renters, you may not, but when you rent, you pay forward. So meaning your April 1st payment when you rent as a tenant is for the month of April. If you're a homeowner, your April 1st payment is paying for March because you own the property. So it's called in arrears. So your payment is in arrears when you're a homeowner. It's being paid forward when you're a renter. So the time frame of when they collect payment it fluctuates a little bit differently, and it's viewed upon a little bit differently. That's why there's prepaid interest that's compiled in that equation. So if you're closing towards the latter part of the month, there might be just a day or so of interest. If you're in the beginning of the month when you closed, the buyers tend to think, oh, I get to skip a payment. They're not skipping a payment. It's just accumulated and accounted for in the closing cost. There's also something called prepaid impounds. And that's just your tax and insurance on the property itself. So taxes are dispersed in this market February and August. So there has to be enough in the pot, so to speak, to make that next payment. And that payment depends on when we're closing. So if we're closing in July, and knowing that there's a impounds tax and insurance payment that's going to be due in August, your prepaid impound account is going to be much larger because they have to have enough in there to make that payment. And then some of that is then prorated out from what the seller would have been offsetting because the buyer had not been living in that property for, half a year at that point, just a month. So there's some checks and balances that happen there. But in case you guys see that in there, prepaid interest, prepaid impounds, that's what that means. Then there's the title and escrow side. So one side's a lender side, the other side's a title and escrow side, which is escrow fees, title insurance. And there's two types of policies. There's a standard policy and a premium policy. I would always opt for the premium policy. And they call it different things for different title companies. I think like First American calls it their Eagle policy. TG, I think, calls it their premium policy, but they know what that is. There's two versions of it. The premium policy is so nominal in its cost, the difference between the two. I mean, it comes out to be a couple of $100, if that, but the level of protection is far, far greater. It's like a no-brainer in which one you should choose. Then there's recordation fees, and that's it's a nominal fee, but it's a cost to record it, to put the buyer on title and take the seller off. And then HARPTA and FERPTA. HARPTA is, both HARPTA and FERPTA are withholdings, not fees or taxes, but withholdings for capital gains tax for the state. If there is a seller that's selling that's a non-Hawaii resident, that's HARPTA, or if they're a non-US citizen, that's FERPTA. And the cost or the withholding is substantial. It's substantial. So here's what I recommend while we're on this topic, because I've seen a lot of this come up in the last couple of months, is if you represent the seller, make sure that you provide the seller with a net sheet that shows them what their proceeds are going to be. And their proceeds, meaning that you have, because on the sell side, there's no lender fees. That's on the buy side, but there absolutely is still title and escrow, right? The title and escrow is split 60-40. So there's still seller fees, there's commissions and so forth. But if you know that the seller is selling a property that is an investment property, meaning that there's a tenant in there or tenant was in there, there's going to be HARPTA and FERPTA that might apply if they're not Hawaii residents. If they're Hawaii residents, they still owe capital gains, but there's not going to be a withholding. This withholding can be so detrimental, and it can catch people off guard if you yourself as an agent didn't even know that that's the case, because that can prohibit someone from even going down the path of possibly listing it. So HARPTA, if I'm not mistaken, is 8.25% withholding of the purchase price, 8.25% of the sale. So listen to what I just said. I'm going to do the math real quick here. If we're selling something for $800,000, 8.25% is $66,000. We haven't even touched commissions yet or spoken about title and escrow fees yet, but yet the withholding is $66,000. Do you think that the seller would be pretty upset with you if you didn't tell them that they might have a withholding of $66,000 in that example? Probably. So you got to have a conversation about it. And is there any way around it? Yes and no. The way around it is to have that conversation with them, to tell them what their proceeds are, tell them that this is a HARPTA or /FERPTA thing that they might, that might be applicable to them. Again, this applies if they're selling an investment property and they are not Hawaii residents. The way around it, so to speak, is that withholding is a worst case scenario because the state basically doesn't want to chase people down if they move to the mainland to go get their money. That's why that's in place. And escrow is charged with holding those fees and not giving them to the seller and collecting them up front. That's why it's called a withholding. So the way around it is having that conversation up front with the seller, having the seller speak with a CPA, having the CPA write, it's a form that they have to fill out and an affidavit they have to sign and a letter they have to sign that's basically doing the math on what should or could be owed in their specific scenario to basically say it's not 8.25% is a worst case scenario. That's not our situation. Ours is actually whatever it is. And I've seen that number go from, like, in this case, 66,000 down to like 10 or 15,000, which they still have a withholding, but it's more true to the actual number versus the entire withholding amount that they then have to go chase down Hawaii Department of Taxation and ask for a refund, which is really tough to get. So just know that. On the buy side, how does this impact you? Well, some of the, I mean, maybe I'm just kind of OCD about these kind of things, but I look at this. So if I'm writing an offer representing a buyer and we're buying a property that was an investment property, and I'll check with escrow to find out, is this property subject to HARPTA or FERPTA? And if they go, oh, I don't even know, I'm already concerned because I'm going to ask additional questions, because that could kill the deal. I mean, for instance, what if in that same example, $66,000, what if the seller, his or her proceeds are not going to be that much, and it's only going to be 30,000, and they're already have a withholding of 66 before you even get into commissions and costs and fees? They're not going to be able to sell. And if I represent my buyer and I'm doing home inspections, that's a cost. Appraisal, that's a cost. Time and energy, the fact that we could have missed out on other offers or properties because we're tied up in escrow on this one. It's still things that are relevant that you should absolutely know about and ask certain questions on. Okay, hold on. I have a HARPTA is 7.25. Thanks, Dean. Of course, it's got to be. Thank you, Dean. Dean's also a CPA. Dean will do all your taxes for free. No, sorry, that's not it, right? No discount on taxes. Thanks for providing that, though, Dean. Appreciate it. So how do loan officers, that's what LOs are, how do loan officers and mortgage companies make money? So as I mentioned before, this is a rate sheet. So this is an actual rate sheet that I got from one of my LO friends. And I'm kind of letting you peek behind the curtain. This might look like mumbo jumbo, but this is exactly how this works. So let's look at, just so that we're all focused on the same thing here, let's look at the top left box. It says on there 21 to 30 year fixed. And then it says 25-year fixed and so forth. Beneath it, it says 10-year fixed, because those are the different type of rates depending on how long that fixed period is for. If you look in the top left box, the 21 to 30-year fixed, if you look at that lowest rate, because everyone will focus and go, oh, look at that. It says rate 2.25, and then it says 21-day, 30-day, 45-day. So what are those categories? That's the lock period. So you guys ever hear where they say, oh, my lock is going to expire? That's what they're referring to. So if they locked it for 21 days, or they locked it for 30 days, or locked it for 45 days, you know, why is that important for you to know? Because it comes with a different cost, a different price and cost. But in addition to that, if you're working with a lender that's locking it in too short a period of time, I literally have had this happen before where we're in a 30-day escrow and the lender is trying to lock it for 21 days. And I'm like, what are you doing? Like, you're literally setting us up to fail. How can we close in 21 days when we have a 30-day escrow? So it's important to know how long that the loan officer and lender is locking it for. In addition to that is, you don't want them to, if you have an easy escrow with limited contingencies, the property is pretty clean for the most part, you want to try to close quick. You don't need them to have a 45 or even a 60-day lock. In fact, there's even such things as 90 and 120-day locks too, which the price goes up because you're buying that locked rate and that security. So let's look at this. Let's look at the rate for a 30-day, which is that second column at 2.25%. You'll notice it says 5.338. So what does that mean? Well, any number on that is a percentage. That is the cost to get that rate. So because 2.25, as you guys probably know, if you follow even a little bit of what interest rates are doing, there is no such rate at 2.25. That's not even out there. But at 2.25, it has a 5.338% cost. That would be the buy down. So the discount point, the buy down that I'd mentioned before, is that. Obviously, I'm sure none of you can even imagine a buyer paying upwards of 5 points to get a certain interest rate. So what happens is you figure out where the par rate is, and that's kind of your baseline. So if you scroll down on the 30-day column and you get down to the rate that says 3.25%, and in that rate there's a percent, there's a parentheses, and it says 0.235. Anything that's in the parentheses is a credit. That means now that there's a little bit of money left over that can then be applied towards closing costs. Or, you know how when a lender says for VA, for instance, they say I have two rates for you. One, and I'm going to use this example. Let's say that the closing cost for a VA loan is going to be roughly around 2 points. So they say, I can give you two rates, Mr. Veteran who's doing a VA loan. I can give you 3.25%. It doesn't cost you any buy down points or discount points, but you got to pay your own closing costs. Closing costs are going to be about 10 grand. Or I can give you a rate at 3.99, no closing costs at all. And why is that? Well, if you look at that column, that 30-day column at 3.99, it's in parentheses is 2.127. That's a credit. So if the loan amount is 500,000, it's 2.12% of 500,000 of a credit that you can give back to the buyer to offset costs and fees. Does that make sense? So if someone was at 3.25, going back to that, and they said, you know what, I really want 3%. Something about that 3% number, I just want 3%. In this case, it would cost them a little over a point to get. That's a buy down or discount because they're getting an interest rate that's lower than what's available on the open market. So this next slide is a better visual of that, where everything that is not in the parentheses is the cost. Anything that's in the parentheses is the actual profit. And then there's this other slide, which I think is interesting too. You ever hear people go, well, yeah, you got to have, because your interest rate is, I thought your rate was 740, but because it's 660, I got to charge you a little bit more for that. Some people think that's completely arbitrary. Like, oh, you're charging me kind of a random fee just because my credit score is X. Well, that's actually not true. If you look at it here, this is basically an adjustment sheet. An adjustment sheet is adjustments that they need to make to either the cost or the interest rate based on a variety of different examples. So for instance, if your FICO score was, in this case, 660, you'll notice on there that there is anywhere from a 0.5 point to a 3.5 point adjustment based on that FICO score scenario. So there's actual like math involved in arriving at whatever that number is. Whether they include their tax and insurance payment in their monthly mortgage payment, there's an adjustment for that. Your loan to value, that's the columns that are up top. If you notice, it starts at 60% or less, 60 to 70, 70 to 75, and goes all the way up to 97. Those are all adjustments based on risk. Lenders have got it down to an absolute science for the most part on figuring out the risk table. So you put down 40% and you have a credit score of 740 plus, and you're buying a single family home and you're including your tax and insurance and all, that's vanilla. That you have the best case scenario. The moment it deviates from that scenario, things change. I can only put down 10%. And I got two loans, a first and a second, as I was giving you. Oh, that changes. You know what? This is going to be, if you notice on the very top, it says investment property versus second home. Huge difference in price adjustment. In fact, the second home adjustment, look at that, 80 to 85% category is a 4.125 adjustment just because it's an investment home versus an owner-occupied or second home. So just know that is not relevant for you to remember, but it's relevant to know that there are adjustments based on risk. Appraisals. So I kind of touched on this a little bit. Appraisals are for the benefit of the lender to determine the risk in lending. Appraisals are ordered through an AMC, which stands for an appraisal management company. In 2010, after the meltdown in 2009, the government came out with certain standards. So before, a lender would just call an appraiser. Hey, John, I got this home that we're going to, do a loan on. Can you go out there? I'm looking for a value about 650. And then the appraiser will go out there, kind of try to make it happen as much as he could, which is a wacky way to do business. But since the meltdown, some of the things and the borders and framework they put in place so things like that wouldn't happen again is basically a blind appraisal ordering process. So now any bank, credit union, lender, mortgage broker, whatever it is, goes through an AMC, which is an appraisal management company, and they'll say, I need an appraisal for on this day, and this is the address. And the AMC, a separate company, is going to pick a pool of, it could be hundreds of appraisers that are licensed with them, and they assign a random appraiser that you don't know, nor did you select or pick. I mean, it could be someone that you've done business with before because it's a small island and a small industry and what have you, but there's no requesting of individuals. So that process is handled through what we call an AMC. Appraisals typically take 10 to 14 days. It could take even longer, especially during the COVID process. It took as long depending on who the lender was. This is also coming down to when the lender orders it. So if a lender is ordering it after J1 and kind of well into the halfway point of the process, that's why you're negatively impacted and extensions need to happen, because they're not ordering it in a timely fashion. So that's another important thing to know when you're dealing with a lender. For the appraisal, there are additional pages that are needed depending on what kind of loan it is. If it's conventional, it's pretty standard, but if it's a Govy, which is a VA, FHA, or USDA type of loan, there are additional documents that are inserted in there too. Appraisers are licensed, and it requires 1,500 hours for them to become an appraiser. So it's not easy. Sometimes, an appraiser is the crux of our business. They can make or break an entire escrow or transaction, but they know what they're doing. Some of them aren't easy to work with, but yeah. And you're right, Dean. Some lenders are absolutely scared to talk to the appraiser because they don't want them screwing things up. Appraisers hold a lot of power, fortunately and unfortunately. Appraisers can point out deficiencies or safety issues if they see them. So this is where it becomes a little bit of an issue too. And I have the next slide will kind of point to some of that. Is most appraisers are not qualified to do anything except for appraise. But because of the power that they hold, some appraisers take it upon themselves to put on a construction hat, pun intended, to kind of go in there and go, you know what, there's a watermark here. I'm going to make this something called subject to. And I'm going to point this out. I'm going to point this deficiency out. I'm going to point that deficiency out. And suddenly your entire transaction has come to a halt because the underwriter will not process that appraisal report with that appraiser having something noted in subject to. It's got to be resolved or remedied. And that's a problem. So why do you need to know this? Whether you're on the buy side or the list side, you got to know what deficiencies there are in the property so you can get ahead of that issue prior to an appraiser getting out there. Because I promise you, it's too late. If the appraiser gets out there, he's either going to note it as being completely deficient, he's going to downgrade the condition of the property so it becomes non-lendable, or he's going to note something that's subject to that's going to require it to be remedied and fixed by a licensed person, whether it's, depends on what the issue is, plumbing or roof or electric or whatever it is. And then he's going to have to go back out there again for another cost and fee to approve that the deficiency was remedied. So it's going to absolutely slow things down. Another thing to note too is on the VA appraisal specifically, you guys ever heard of a Tidewater notice? It's unique and specific to VA. What a Tidewater notice is a notification from the appraiser that says, I know you're looking for whatever value that we're under contract for in this purchase contract, but it's very likely I cannot bring that value in. I don't have enough data. That's basically what he's saying. You don't know if it's short by $1,000 or short by $100,000. It's basically a notice to you as an agent, whether you're on the buy side or list side, to start pulling together as many comps as you possibly can to check if there's any new closings that may have occurred from the time that the appraiser went out there till now. Maybe even off-market sale stuff that you might be privy to that you can obviously document and prove to get that value up. So a Tidewater notice is not a good thing. A Tidewater notice, and it's not for FHA, USDA, or conventional. It's specific to VA. Honestly, I wish other loans had some sort of notification like that, but it's called a Tidewater notice. So with that said, whatever the outcome of the appraised value is on VA loans, is that value is recorded and kept on record for 6 months. So new agents know that that's a thing. I mean, if you're a listing agent and the property appraises for 500 and you have it listed for 600 and it's done through a VA buyer and you're in an area that is a high density of VA buyers, the education and conversation that you should be having with your seller is it's not as simple to go, yeah, forget this guy. We're just going to put it back on the market at 600 again and all will be well. Maybe if the next buyer is not a VA, or the next buyer does not mind, and you have an appraisal clause in there that that buyer might cover the difference. But if you're in an area that is extremely dense of VA buyers, and it's expected that they're going to write another offer that's a VA loan, the very moment that they go to order that appraisal, it's going to pop up and say, this was already appraised for 500. And it's going to be a deal killer all over again. So know as a listing agent that's the conversation you should have. On the buy side, how can you use that to your advantage? Well, if the appraisal doesn't come in, it kind of is what it is at that point. You would then if you don't have an appraisal clause in place, or if you do, beyond that gap, whatever that, if you're covering 30,000, but the gap is 50, obviously you're going to want to renegotiate and try to get that down for the benefit of protecting your buyer. But how that benefits you is, believe it or not, a lot of real estate agents don't even know that 6-month rule to begin with. So if I'm a buyer's agent, I'm calling the listing agent and saying, hey, listen, we'd love to continue with this transaction. We're so close to the finish line. And I would hate for you to have to start all over again with listing it on the open market, going through offers all over again. I'm sure you know this already. You're an experienced agent, but the value sticks to the property for 6 months. And with all the VA loans that happen in this particular area, you're going to go, if we cancel or we don't succeed in closing this transaction out, you're going to deal with this again in a heartbeat. So let's just try to see if we can negotiate and get this price down so we can create a win-win. That's the conversation that I would be having if I'm on a buyer's agent, knowing this information, if you didn't already know that. So does that apply for all states? If you're talking about the VA thing that I just said, yes, that's a federal thing. So it applies to every single state. And if that's not what you mean, then you can come off on mute and tell me otherwise. So this next page here is just a snapshot of there's a bunch of pages in the appraisal report. This is just one of them. I just wanted to show you what it looks like. It's very confusing if you don't know what you're looking at. If you do know what you're looking at, it's pretty easy to say that on the left-hand side is a subject property. A subject property is a property that we're talking about that's in escrow, and it has what the current sale price is and how many bedrooms and the square footage and condition of the property and all that kind of stuff that's kind of, down that column. To the right of that, it says comparable sale 1 or comp 1, comp 2, and then comp 3. Though that's super important because there's typically speaking, even if there were model match homes, like everything was cookie cutter, exactly the same, there's still going to be something called an adjustment. And an adjustment could be because of view. So even if the two condos are identical, but one has an ocean view, whereas one has a mountain view, there's going to be an adjustment for that. But typically it's going to be condition, upgrades, wear and tear. If it's not a model match, they're going to adjust for square footage. There's other things that are going to come in place. And that's in that red box that I have there, that's accounting for that adjustment. So you can see how an appraiser is giving or taking away value based upon what he sees as recently sold versus the subject property. Beneath that, you'll notice on there, it says Tidewater. So that's an example of a Tidewater notice. And so even if this situation were resolved, it still notes on there that there was a Tidewater notice. Then beneath that, it says what the indicated value is by the sales comp approach, which in that case, I think it says 505. And then on the bottom, it says, there's a little box. It says as is, which is checked, or the box next to that, which is the death of all appraisals, which is subject to. That's the example I was giving before. So subject to, if that's checked, you got to pump your brakes because there's an issue that's happening that we need to get resolved, and it could delay closing on time. So subject to as an example could be, so on a VA loan, you guys might know you can't have any exposed wires. You can't have any what would appear to be safety issues. You can't have a pool that's empty, that doesn't have a fencing or some protective guard around it or that kind of thing. So there's a lot of rules in place as a safety mechanism to protect the veteran. So if you know this as a buyer's agent and you go look at an open house or you do a showing and you see this up front, these are things that you're going to want to have remedied prior to making your offer, or at the same time of making your offer, but certainly prior to the appraiser getting there. Because if you know there's cracked glass or there's a chandelier that's missing and wires exposed, Those are things that are a hard stop for a lender. They're not going to allow that if the appraiser calls that out and it becomes subject to. So you want to make sure that you get ahead of it. If you're on a listing side and you're taking a listing and you're doing a walkthrough of the property that you're going to be listing, and you see these kind of things, fix it, get it all remedied and fixed prior to even listing it, so you don't have that problem, especially if you're in a high VA market. So the property can still be in, it can have cracked glass, can be in poor condition or what have you, and be a conventional loan, and it might not be subject to. The subject to is when it's a real safety issue or structural issue, or a structural concern, or certainly if it's a government loan. So keep that in mind. As far as comps go, there's a lot of people that agents will go, yeah, there's a comp over here, and that property sold for like 2 million, but mine is 500,000. That's not a comp. Like, a comp is as close to that property as possible. So this is an actual screenshot from an appraisal report of where the comps are. So this is in the same community, in the same gated community. So that all those things that are in there are absolutely comps. They need to be as close to the subject property as possible. When I say as close to, I mean both in time and distance. So if it's in the same building, if it's a condo, same community, if it's a townhome or gated community, there is exceptions to that. So if you have a unique property, they can go further out or go further back in time, but they might make adjustments for those kind of things. So myths and facts about credit. One thing is, it drives me nuts. It's called FICO score, not FICA score. I keep hearing people say FICO score, but it's called a FICO score. That's your credit report. When you run your own credit, so in other words, ordered from the bureau yourself, or if you use an app like Credit Karma, and you see a score and the score says 7, oh my God, my score is 740. My score is amazing. That's your raw score. Raw score meaning there's no layered risk applied to it. So if you notice, if you've ever looked at credit reports, on the credit report, the people that are pulling your credit. So if you go to like Verizon to open up a new cell phone account, or if you call HECO to open up an electricity account, or if you go to a car dealership to buy a car and they run your credit to get approved for a loan, there's a layered risk that's applied to their credit inquiry. And their layered risk that's applied is dependent upon the risk of the industry that they're in, that they're running your credit for. So in other words, if you're getting a credit card, and let's say all these things occur on the same day. This morning I went to Verizon and they pulled my score. My score was 800. Because I'm getting I said a credit card, but I'm getting a mobile phone. It's a small risk. It's a small bill relatively on a monthly basis. So I get an 800 credit score. And then I immediately go across the street to Servco to get approved for a loan. And they run my score. My score is 740. Did my score drop? It didn't drop. There's a different layered risk that's applied. So there's if I'm applying for now a loan potentially that's $500 or $600 or $700 per month, that's far riskier than me applying for use of a mobile phone with a bill of $100 to $150 a month. And then if I call my local lender and have them pull my score then might be not 620. It might be a 7 to 720. Did it drop? It didn't drop. There's a different layered risk. And with a mortgage, that's the highest risk possible. So just know that is a thing. So people kind of get caught up in, oh, well, I ran my own credit and it was much higher. It's just because there's a raw score, and Credit Karma and those type of things are in fact, I have it because I'm looking at my scores all the time, but I don't look at it for the score portion of it so much as I'm looking at it for the data portion of it to see if there's anything on there that's erroneous or, what my available credits are and that sort of thing. So there's a purpose for that, but the score itself will change depending on who's running it. Your scores don't drop after every inquiry. That's kind of a thought process. There's 3 bureaus that pull your credit. And what lenders will do is they'll use what's called a merged score. And they'll take your middle score. And in your middle score, it's not an average. It's not an average of all 3. It's literally the middle. So if your one score is 800, another one is 840, and the other one is 600. I know that's a wide range. It wouldn't happen like that. They would take the middle one. They're not averaging them out. And those 3 bureaus have a certain tolerance for how many inquiries that you can have on an annual basis. So generally speaking, scores that are above 740 are all in the same tier, meaning that they're high credit score. You have the best options for loans and so forth. You need a higher score for lower down payment or higher risk loans. You do, but there are different loan programs available, such as the next one, FHA, goes as low as 500. So your credit score can be very, very low and still qualify for an FHA loan. It's not a given, by the way. They have to do the math and underwrite it, but know that if someone has some credit challenges, they might be a good candidate for an FHA loan. What are overlays? Overlays are, as I mentioned before, is if you're in a condo or if you don't impound your tax and insurance in your monthly payment, or the condition of the property is less than desirable, or your credit score is lower than desirable. Those are called overlays, whereby that specific lender is going to charge you a little bit more for that circumstance that you're in that makes it high risk. Why can't you co-sign for a house like you would someone with a car? When you co-sign for someone, when it's really being a co-borrower, they're going to take the worst case of both, right? Of both people. So if, for instance, your parents are co-signing with you to buy your first home and your parents live in a different state, that purchase automatically becomes a non-occupied purchase, which is basically an investment property. And you're going to say, well, yeah, but I'm on the loan too, and I live here, but they don't. So it's not that simple. It happens from time to time and it works from time to time. But you're going to be hit with the worst case scenario if one of the occupants or borrowers are not occupying the property. FICO scores are made up of the following: payment history. 35% of your score is made up of your payment history. 30% of your score is made up of your total amount owed. 15% is the length of your credit history, so how long you've had credit for. 10% is new credit, and 10% is a type of credit that's used. Type of credit is revolving debt, credit cards, mortgage, student loans, that sort of thing is made up. That combination is made up to contribute 10% of your score. So in this portion, C2 of the purchase contract, I put that in there because people kind of put all kinds of crazy things in there. In the section where it says by way of, you want to be accurate as to what kind of loan you have in there. And it's important for you to know as realtors and as agents, what kind of loan your client is getting so that you can properly calculate the down payment. I see people put things in there that seem strong and favorable and it can create an advantage to getting your offer accepted, but they didn't even check with the loan officer to find out, is it really a 20% or 30% down? Oh gosh, it's only 5%. Well, that changes things, right? Because the seller can then say, and the listing agent can then say, we accepted your offer based upon how you wrote the contract. And being that you're not putting down 30 or 40% and only 5%, we would have taken another offer. So you got to make sure that you understand what the down payment is. And then by way of should illustrate the type of loan it's in. So by way of a new 30-year fixed conventional mortgage. And I always like to throw in there with rates and terms acceptable to buyer. Or by way of a new VA 30-year fixed mortgage or FHA or whatever it is. That should be illustrated there, because if you don't put it in there, no one's going to know. The seller or the listing agent is not going to know what kind of mortgage it is. Some of the pitfalls is the property not appraising, of course. Cracked glass on VA. I said that. That's one of those things where it's a big deal, but people overlook it all the time. Shared driveway easements on a CPR. So imagine you have a property that's in town or whatever, and it's 3 or 4 single family homes, not adjoining. They're all separate. They all have their different fences, but to access every single one of them, there's a shared driveway, and then it kind of splits off. when one of the pitfalls when you're either when you're listing it or when you're on the buy side, is to find out, is there a shared driveway agreement? And what does that even mean? The purpose of that is to determine who's responsible if there is work to be done on the driveway. And is those easements in writing? Do they expire? If they expire, meaning if there's a house in the back that is really the owner of that driveway and he's giving an easement or a right of way to the 3 other owners in front of it, if that expires in a year and this person's buying this home with the intention of being their forever home and living in it until they die, that's not a good thing if that driveway expires or that easement expires in a year. Or if there's no agreement as to the maintenance of it. What if it needs to be repaved? Or what if there's a a sewer line that breaks and construction has to begin, and that sewer line runs right underneath that driveway. Who's responsible for it? Just because there's 4 homes that might have access to or share it doesn't mean it's the cost of maintenance is split equally 4 ways. So make sure you know that. On VA, make sure that there's smoke detectors in the rooms that should have them. Some of the other pitfalls are square footage doesn't match public record. That happens all the time. Just know on an appraisal, the appraiser will give credit to what is on public record, not what's physically there at times. So in other words, if it's a 3-bedroom home that's 2,000 square feet, and then he physically goes there and it's a 5-bedroom home at 3,000 square foot, he's giving value to what is permitted and what's on public record. He's not giving value to he'll make note that it doesn't match, and he's looking for quality of workmanship. But the downside to that is if it's not permitted, you're not going to get the value for it, at least by way of a loan. Making large purchases while in escrow. So this happens sometimes when people are buying furniture to fill the new property that they're getting. That can absolutely disqualify them from purchasing or closing, or buying a car, or God forbid, a boat or some other kind of toy. That's a huge expense. Borrowing money or closing gifts, or closing costs rather, or gift funds. Those things can throw things off. Mattress money. Mattress money is cash. Everyone, has whatever they do to keep cash on the side, but you can't use cash. If you're talking to a buyer, first-time home buyer or whatever, and they go, "Oh, I'm good. I have cash. I have 30,000 in a safe." You have to, when you're doing the buyer consult, you got to immediately tell them they got to deposit that money into an actual bank account, because the money has to be what's called seasoned. And seasoned in lending simply means that it's been sitting in an account for a certain amount of time to get the average balance up. So it's not enough to have $30,000 in this bank account if that's what's needed. It has to be $30,000 with an average days or average balance of 30,000. The average balance is, every bank does it a little differently. Sometimes they average it out over 30 days, some average over 90 days. But if the average balance is literally 1 day, that means they just deposited that $30,000 yesterday, and prior to yesterday, they had no money in there at all. So that's really, really important to understand. No mattress money. Last minute credits. This happens often. Where you guys as agents are negotiating because there's some issue that might come up, but in the last minute of trying to fix something, there's a credit of $3,000. Well, if you don't let the lender know immediately, that can throw everything off, and it's going to delay closing. So know that if you even think that you're going to give a credit to the buyer, and there's a loan involved, or the seller is going to be providing a credit to the buyer, you got to let the loan officer and the underwriter know immediately. Lock extensions are a tough one too. Make sure that you know when that lock is expiring, as we kind of talked about before. That's a huge expense potentially to the buyer, and sellers typically don't want to pay that at all. Large credits are a potential red flag. Large credits could be like $10,000 credit, because an underwriter is going to go, wait a minute, what's the $10,000 credit for? Because their concern is their investment in the property. And so if there's something that's structurally or safety related wrong with the property, they're going to want to know what that is. And that could be a deal killer too. Leasehold financing is another one. Typically speaking, leasehold is almost impossible to finance. You would get a private money loan, or the loan, the lease term has to exceed the loan term by 7 years. So in other words, I see this all the time for whatever reason. There's a leasehold property that expires in 15 years, and someone goes, yeah, I'm going to get a 30-year fixed. How can you get a 30-year fixed on a property with a leasehold term of 15 years? So what the rule is the lease, if it's a 30-year fixed, the lease term has to be at least 37 years. It has to exceed the loan term by 7 years. Foreclosure watch. Here's the good news. I'm going to skip through this pretty quick. We're not on it. But it's a thing. Be aware of those kind of things. This is a snapshot from Gary Keller's vision speech. It's available on online right now. It's really good. The reason why I even bring this up, and I thought was a brilliant slide, is everyone gets caught up with. So if you're an agent working with first-time home buyers, and people are like, you know what, is now a good time to buy? Maybe I'll wait. Maybe I'll wait until prices come down. Well, here's the thing, right? There's something that's called inflation. And they put the slide together to account for vehicle inflation, gas inflation, house, both price and mortgage, and wages and inflation. And they're all very impactful. I mean, if you look at it, in 1989, you could have purchased a vehicle for $15,000, whereas today the average is 46. That's amazing. 89, gas was 97. 2021 is 350 to 51. Certainly not here. I don't know about you guys, but that was upwards of $5, almost $6 the other day. Houses average 89, 94,000, 2021, 347. And then the wages, right, have changed too. But here's the thing that people have to understand too is in the mortgage column, it's gone down by nearly 24%. In the 80s, the interest rates were in the double digits. So that's something that you have to account for that. So when we're talking to buyers, is it a good time or bad time? I can tell you firsthand that I'm always on the lookout for property. It doesn't matter if it's a buyer's market or a seller's market. When have you ever met someone who's owned a property for 7 to 10 years between that time frame and said, you know what, I shouldn't have bought that property? I guarantee you, as a general rule of thumb, most people who have owned a property for that long or longer are so thankful that they even have that property, because that property has gained them more equity than they would otherwise be able to save on their own. It's almost a certainty. I have more money in all my different properties that I've owned the longer that I've had them in that property in terms of equity than I have saved up in the bank, without a doubt. That property is a mechanism that earns you money and builds you wealth. So when's the best time to buy a property? It's 10 years ago. And the second best time is right now. And evidence of that is, even when prices may be coming up and coming down and what have you, if the only time where those prices, that fluctuation in price really matters to a potential first-time home buyer or a buyer in general, is if they're a flipper. Because if you're flipping a property, you want to get into that property and offload it as quickly as possible. And if we're having a fluctuation and a reset in the market, they could lose big time as a flipper. But as a general rule of thumb, we're not talking about that. We're talking about buyers, whether they're buying the property for 3 years, 5 years, 10 years, or their forever home. So no, those kind of things really do matter. So when you're talking to clients, so I'm going to stop here and ask, does anyone have any questions that I can answer for them? I don't want to go too long and bore you to death. These are number things, and I don't know how interesting it is to some of you guys, but does anyone have any questions? You can ask me on chat. You can come off of mute and ask me anything that we've gone over, anything that might help you in terms of what you're dealing with clients, mortgages, anything like that at all. As I've lost everyone. Everyone has fallen asleep due to talking about math. Well, yeah.
It's cool.
Hey, Cole.
Yeah, I missed a portion of it, but you're saying something about a loan where it's based off just the income of the property, not necessarily the borrower's income or credit.
Yeah, that's a commercial loan. So I had just mentioned that commercial loans can be used to purchase industrial, warehouse, commercial buildings. But in the case of the income producing portion of it, that would be properties that are over 4 units in size. So 5 unit and above would be considered a commercial loan. And the way that underwriters typically underwrite those types of loans is based entirely on the income. So they're not basing it on, you could be unemployed for that matter. And they really don't care. They're basing it on the income that property drives. I see.
Do you know if anybody does one for like a 3 unit, like less than 5 units, for like a residential multifamily?
Are you asking if I know any lenders that do that?
Yeah.
The lenders that do the commercial stuff, the 5 units and above, are, those are the typical brick and mortar lenders like Bank of Hawaii and American Savings and those kind of things will do those kind of loans, and they're basing it off of income that the property is producing. So that's where I would steer you or a client to for that type of thing.
Okay, thanks.
And hi, Gabby. Yes, this is being recorded. We'll send that out. Any other questions or comments or anything like that? I'm getting a lot of direct messages. Thanks, guys. I appreciate all that. Any other questions that I can answer for anyone? Oh, yeah. Hi, Steph.
All right, now I'm off mute. So recently I've heard something that came back into play in the mortgage world, and I wanted to know your opinion because it is a no income like how we used to do, but you have to put 25% down, prove some kind of an asset, not a whole lot. I think it's only like 3 months worth. Of course, have a great credit score, but then you don't have to show any income as far as debt to income or anything like that, and you can get a loan. So I want to know your thoughts and experience on that, because it seems like a good loan for me, since I don't have, I haven't been in Hawaii forever, and I can't really prove my income, but I have enough income to buy a house.
Sure.
But it makes me nervous from the loans that we used to do back in like 2006. So
yeah. So there are so the no doc type of loan programs are coming back. This happens. This is the cycle of loans in our industry. When people and investors get more comfortable with how their portfolios are producing, they tend to ramp up and get a little bit more risky in terms of the loans that they'll provide or offer. And I've seen a bunch of loans show up recently that are no doc loan. No doc loans means that the buyers are not documenting their income or documenting their employment. They're varying different degrees. They are not, just so you know, conventional loans. They are not loans that are FHA or USDA. They're not any of those kind of things. They're typically either private investors or smaller company or group of investors that are lending it. What do I think about it? I think there's a place for all those kinds of things. Meaning that I don't want it to be like how it was before, where salaried individuals, like those that work at a company or those that work in the military, are doing those kind of loans, because that's what was happening before. And I think that that's the wrong loan for the wrong person. But if you're self-employed, to your point, Steph, if you're self-employed, you absolutely have great credit and you have great reserves and great down payment, but you don't have the necessary income history or the employment history yet, but there's a home that you want to get. I would say that's great. The nuance that you have to look at, like with anything, would be looking at the contract to find out, is there a prepayment penalty? That's a killer. So you got to make sure, is there a prepayment penalty? What are they even charging me? Because if it's a high risk loan, they're charging you to do that loan. So is it in the form of a higher rate? Is it 1 or 1.5% higher than the normal rate? Well, okay, I get it. That's not too bad. Is it a interest only loan, which on the surface sounds great because your payment is lower, but at the end of whatever short term that is, 3-5 years from now, whatever it is, you paid zero towards the principal balance? Or is it a balloon loan? Like the answer is, I don't mind those kind of loans if it's for the right buyer, but you really have to deconstruct the terms of that loan to ensure there's nothing tricky in it. And by the way, I can help. I know that you came from mortgages too. I can help you with that, or help anyone with that if ever you're in a situation where, like, what does this loan package even mean, and how is it detrimental, or is it a good loan? I can help break some of those things down for you. Was this class, by the way, Steph, was this flashback for you, looking at rate sheets and all that?
Yeah, a little bit.
People who've come from loans, like, we appreciate that we've done them. I don't think we ever want to go back and do it again, though. Any other questions or comments or anything like that? No? All right, guys. Oh, yes. Hi, Raji. You're on mute, by the way. You got to take yourself off mute.
Can
There
you
you go.
hear?
Yep.
I have a quick question. I haven't done any transaction with VAs. With VA loan, is there any mortgage insurance involved?
No, the great thing about VA loans is they allow for 100% financing. There is a VA funding fee that the veteran pays up front, but there is no PMI or mortgage insurance that's added to their monthly payment. So that's one of the benefits of having a VA loan. So no.
Okay. And one more question. How long this seller market is going to stay like this?
That's tricky. I kind of hope that it doesn't stay like this. There's a lot of reasons for that, because it's not sustainable in terms of the equity increase. I mean, we're going to end up pricing ourselves out and buyers won't be able to buy. But I'm all for, and I'm always big on, allowing the market to properly and safely correct itself. Interest rates are continuing to rise. And if it does so in a slow and steady fashion on its own, the good news is everything will start to kind of equalize and balance out on its own in a healthy way. It's when there's too much government intervention on one way or another that causes rates to rise and prices to plummet, or vice versa. I don't anticipate that happening at all. But I think that we're still, the good news for having a strong market is there's still a low inventory. So regardless of what happens, we're still in a very low inventory market. So that's great. Any other questions or any? Thanks, Renata. If that's it, I appreciate you guys letting me pour into you and letting me chat with you and putting up with me for this time frame. This is recorded. We'll put it on our Google Drive. We'll put it on our Google Classroom. If you want a copy of it, we'll send it over to you. But thank you guys so much. I hope you guys have a wonderful rest of your day. Talk to you guys later.
Thanks, Chad.